Good morning students, I am Ms.T.CAROLINE VINCY from the Department of Business Studies. I am going to brief you about financial management. Financial management is actually a very easy scoring subject. So you will have 60% theory, 40% problems. So if you think about financial management, it is about managing finance effectively and efficiently. So if you are a financial manager, you should know about proper allocation and effective utilization of funds. So the finance is the lifeblood of every organization. So I am going to brief you about financial management. So to start with financial management, the meaning of financial management. The financial management is about effectively and efficiently managing and allocation funds. Many experts and personalities have given the definition about financial management. In short and general, financial management is about acquiring funds, utilization of funds, allocation of funds and earning adequate profit. So this is all about the meaning of financial management. So while thinking about finance, management of finance, when you promote a business idea, essentially you should think about how to acquire the funds. So when you think about acquisition of funds, there are prime important decisions which you need to take. So the first important decision is about financing decisions. So when you think about financing decisions, it is about procurement of funds. At the right time, you should procure the funds. This will be helpful when you have a proper capital structure. Determining a proper capital structure. Capital structure is the composition of capital, whatever you have adopted in your business organization. The proportion of debt equity mix. This is the right component of debt equity mix will help you to acquire the funds. So why do you need to acquire funds? You need to acquire funds for investments. You need to acquire funds for estimating your working capital requirements. You need to acquire funds to meet your day-to-day expenses. So acquirement of funds is a very important financial decision that every financial manager or every businessman has to take. So the next important decision is investment decision. So after acquiring the funds, the next step is planning your investments. So how are you going to plan your investments? When you think about investments, you should first evaluate your investment opportunities. It is a very crucial decision to be taken, where to invest, how to invest. So when you think, two aspects should come to your mind with regard to investment decision. One is evaluating the risk return in the investments that you are going to make, and the second is the minimum rate of return that you are going to take on the investments. Also, with regard to investment decision, you should know the opportunity cost of the investment you make. So with regard to investment decision, you should keep in mind assessing the investments based on profitability and the return you get on the investments. The third important decision about financial management is dividend decision. So once you have acquired the funds, you have invested, from the profit you get, you need to make payment of dividend. So dividend plays a vital role in every business. Dividend reflects your market value. So dividend decision is a major financial decision taken by every business organization. So while thinking about dividend decision, the proportion of dividend you are going to pay is called as dividend payout ratio, and the proportion of retention, you call it as retention ratio. So the retention ratio or retained earnings, depending on the payment of dividend only, your market share price will increase or decrease. Many people will start coming to purchase your shares. So dividend decision is a very important decision. The last and foremost decision is a liquidity decision. Liquidity means availability of cash at hand. So you can assess the liquidity position of a firm based on current assets management. You should effectively manage your current assets. So as you all know, current assets are the assets that are easily convertible into cash. So the readily available cash at hand will tell you what is your liquidity position. Liquidity decision is a very important decision that the management has to take with regard to current asset management. So investment in current asset in the mid of a production cycle will adversely affect the liquidity position of the firm as well as affect the profitability of a business. Managing the liquidity decision of a business. So these are all certain important areas in which you have to consider, make important decisions. Liquidity decision is an important decision which every firm has to take. So, what is this liquidity decision? This liquidity decision is about the liquidity position of a firm. So, when will you know the liquidity position of a firm? When you properly manage your current assets. Efficient management of current assets. Current asset means assets that are easily convertible into cash. The cash that is readily available at hand. This what tells you what is your liquidity position. When you are able to meet your day-to-day expenses, then you have a sound liquidity position. So, how you are going to manage this current assets? Timely investments. In the mid of a production cycle, you cannot go and make investments in current assets. So, you need to decide the right time where you can take risk in investing in current asset. So, it is very essential to manage your liquidity position for a smooth running of a business. So, the next topic that I am going to discuss is about objectives of financial management. If you look into the objectives of financial management, for every business concern, the major objective is profit. Profit is the only measure of a business performance. So, profit will help you to face all your costs. Profit will help you to expand your growth. Profit only will help you to face all the risk and face the competitive world. So, profit is a basic measure for every business. So, here objective of financial management is not only about profit but maximization of profit. What is this maximization of profit? When a firm is able to produce maximum output with minimum input or with a minimum input maximum output, that is what you call it as profit maximization. In simpler terms, when two similar industries, profit maximization is about when a firm is able to produce maximum number of output with minimum input, that is what you call it as profit maximization. It is the point where the firm is able to prove its efficiency. So, in a competitive world, in the existing market, two similar industry profiles are existing in a market. Then when customers like you and me are going to purchase products of A than B, then product A has achieved more competitive advantage than product B. So, this is the point where product A has achieved profit maximization. So, profit maximization is the ultimate goal of every product, every business organization. So, once you have achieved this profit maximization, next step is becoming a leader in the market. The profit you have maximized will help you to become the leader in the market. You will try to accumulate the wealth of the market. So, that is the next objective of financial management, that is wealth maximization. Wealth is created by a company is reflected in the market value of its shares. How can you increase the market value? By increasing the value of investments. So, when you evaluate your investment opportunities, you should consider the capital budgeting decisions, NPV, discount factors while making your investments. Net present value of an investment will obviously increase the wealth of the shareholders. What does that mean by increasing the wealth of the shareholders? Increasing the value of your business. So, this is all about wealth maximization. Till now I have discussed about the meaning, the prime areas of decision, and next I spoke about objectives of financial management. So, this will give you an idea or introduction about financial management. So, in the upcoming topics you will have working capital, where you have to estimate your working capital requirements. You need to calculate your current assets, you need to calculate your current liabilities. Current asset minus current liabilities will give you the estimate of your working capital requirements. Today's scenario, estimating your working capital requirements is very essential for a smooth running of your business. The next about is capital structure. The composition of your capital structure, like I already told you, capital structure are the various components you have adopted in your business organization. That is what you call as capital structure. The proportion of debt equity mix. This is very essential for you to increase your market value. The next upcoming chapters you will be learning about cost of capital, the return you get on the investment you make, the opportunity cost of your investments. Among various investment proposals, you have to evaluate your opportunity cost of investment. The next you will be learning about dividend policies. Dividend policy is very essential for every business organization, because dividend policy only will help you to make payment of dividends, retain earnings, plow back your retained earnings. So, this is very essential topic. This gives you a whole picture about financial management. In the upcoming classes, we will be discussing in detail about working capital, cost of capital, capital structure. This gives you a picture of financial management. Thank you.